Hi and welcome to this Fireside chat with the ABG Sundal Collier. My name is Simon Göthberg, an equity analyst here at ABG. And with me today I have Simon Göthberg, the CEO of Vestum. And for those of you who don't know Vestum, Simon, can you please maybe give a short introduction about the company?
Yeah, sure. So Vestum, we focus on acquiring and developing the most high quality, highly specialized niche infrastructure companies within Northern Europe. So focus on Sweden, Denmark, Norway, and the UK, with sales of some 5.5 billion and a margin of 10%.
Great. And I want to start talking a bit about your strategy maybe, and give you an opportunity to reflect on the past. So maybe, first of all, go through how you view what's happened since the listing, with your M&A strategy, how has everything played out compared to what your plan was before you went public? Because I know you had a quite clear plan of why you went public and so on. So just go through, what happened and did it go according to plan?
Yeah, sure. So we started thinking about Vestum in 2018, really, when Conny Ryk, our current chairman of the board and biggest shareholder, came with me with an idea of acquiring and developing small cap niche companies within critical and civic infrastructure, and really do a roll up of those companies and create an umbrella to extract synergies and to continue make operational improvements and grow with acquisitions and high organic growth. And then in 2021, we started out, made a lot of acquisitions. We were highly acquisitive in the first 18 months. We had interest rates that were low, inflation rates that were low, and really an M&A market that allowed for a high pace of acquisitions. So in the first 18 months, I think we made 52 acquisitions, mainly in Sweden, but also in Norway, Germany, and Finland, actually. And then 2022 came along with everything that happened with the war and high inflation rates, a fast-paced increase in interest rates, which really made us change focus towards the balance sheet. So in the last sort of 12 to 18 months, we focused on ensuring that we have the right capital structure going forward with the new interest rates, really. So we've gone from, I think, a little bit over 3 times in leverage to 2.7, and now more so focus on water infrastructure. In the beginning, we had a wider focus on the infrastructure market, but now, I would say in the next 12 to 24 months, we're more so focused on allocating our capital towards water infrastructure.
And what made you make this change in sector investments?
Yeah, so I would say that if you look at services versus products in Vestum, in the early days, we had basically 50-50 or even more so focus on services. And those companies are great because you have local presence and really strong market players that can achieve high margins in that respective market, but it's difficult for those companies to scale. So we've become more focused on acquiring product companies that can scale a little bit better, because the infrastructure market in Northern Europe looks basically the same. So we can use the distribution channels and sales channels really from the other companies to gain market exposure in new countries. And that has made us gone from basically 20, 30, 40% of products to now a little bit over 50 almost. And the structural growth and the margins in water infrastructure is so much higher. And also operational risks are a little bit lower because their products don't really have projects in the same way that services have. And this basically means that contract assets in relation to sales have come down and quality of earnings have increased.
Yeah, and you also talked about the problems with increased funding costs, interest rates going up, and you had to postpone further acquisitions. But now, recently, you actually made a new acquisition, PDAS in UK, also in the water segment. So what's your like early feedback from that acquisition, and what was the rationale? Of course, this was part of your plan to move more towards water, but more specifically within water. What is the plan with PDS, and what do you see in further acquisitions within water?
Yeah, so I would say that the PDS acquisition was mainly made by Pump Supplies, which is our biggest company in Vestum, and obviously the biggest company in the water segment. And the managing director of Pump Supplies have met with PDAS for many years, both in terms of discussing commercial aspects, because they were doing business with each other, but also in terms of trying to buy that company. And the best way for us to source new acquisition opportunities is to use the platforms that we have within Vestum. So PDAS came to market in, I guess, Q4 2023, and then I met with the management team, and the acquisition was completed in August this year. So the Pump Supplies and PDAS have synergies in terms of procurement. We procure silent water pumps from really in both companies, but with different discount rates. And now we can add sort of higher volumes at higher discounts, meaning quite substantial procurement synergies. So that's one thing. And then PDAS is mainly focused on a intelligent monitoring system where they monitor pumping, wastewater pumping stations. And in Pump Supplies, we install and sell those pumping stations. So now we can use the monitoring system and roll that throughout Pump Supplies, but also throughout the entire water segment, really. So we have synergies in both procurement and sales, I would say.
Great, that makes sense. And looking ahead, further acquisitions down the road, is this the kind of acquisitions you want to do more of, or would you prefer to maybe do other kind of investments in water, or how should we view that?
Yeah, so I would say that water infrastructure is an issue not only in the Nordics, but it's a global issue, right? We have underinvestment and aging water infrastructure, but also climate change with floodings and droughts, and all these drivers really create a large market opportunity. And our positioning is between the large OEMs, the Xylems and Grundfos, and the end customers. So with the system integrators, the niche manufacturers of, let's say, control panels, and the value-added distributors. So how we view this really is to grow our existing platforms with additional add-on acquisitions. All of these platforms in the water segment have external CEOs running those companies, meaning that the dependency on the CEO is quite limited. So to continue the sort of acquisitive growth in these platforms, but also to add new markets. So I would say that in the next 12 to 24 months, we will remain within Sweden, Norway, Denmark, and the UK, but then to add additional markets such as Belgium and Netherlands and Italy, because those markets are heavily underinvested as well, and there's a ton of there's a fragmentation here. So to add more products and services in those companies, or in those markets.
And the water segment is, for you at least, is margin accretive. The margin in water is higher than group average, and you are currently at around 10% EBITDA margin, and you have a target of 12. Should we expect that a further focus on like the water segment is that the main thing that will take you to 12%, or how do you view that journey from current 10% up to a target of 12%?
Yeah. So I would say that in terms of capital allocation and looking at acquisitions, we will be focused on growing the water segment. And in the last 2 years, we haven't really made any acquisitions, right? We focus on bringing down debts and to refinance the entire capital structure. But now, as we continue to grow with acquisitions, those will be focused towards the water segment with high margin players. As you mentioned, the water segment has margin of roughly 20%, I think 20.3. So as that segment grows organically, and as we continue to add new acquisitions, for sure the margin will increase. But there's also two other things I would say. One thing is to increase prices in those market leading players that we have outside of the water segment. And the second thing is in December last year, we made some divestments, right, of underperforming, well, the infrastructure companies that were structurally stuck at low margins and rather high operational risk. There could potentially in the next 12 to 24 months be additional divestments of companies that are stuck at 3, 4, 5% in margin. That I would say that it would be better for us to reallocate that capital towards the water segment, or to add new products in services and infrastructure. So when all those things come into play at the same time, organic growth in companies that scale well with margin expansion, acquisitions in the water segment, and potentially something coming out of some of the other segments with low margins, then I think we'll be well above 12%. So the target is minimum 12%, but the ambition is to take Vestum to something substantially higher. And I think 15% is doable.
So you think further divestments are an opportunity or potential for you to?
Yeah, when we make an acquisition, the ambition is always to keep that company indefinitely, right? But then things happen as we go along. And I think if we fast forward 10 years, 20 years, it's just a nature of the game that divestments will be a part of our business model. We view ourselves as an industrial player, but also as a capital allocator, right? And if we see that we have companies that are underperformers or structurally stuck at something where we don't wish to be, I would rather take that capital and invest it in something else. So divestments is something that we will continue on doing. Then, what we did last year was a rather big move, right? I would say that as we go along 5, 10, 15, 20 years down the road, then it would most likely be something smaller, right?
And what kind of segment are we talking, like capital intensive infrastructure services or installation services, or more of the product companies? Where do you see that you still have companies that are underperforming in terms of profitability, where this could be an opportunity to divest?
Yeah, so typically what happens is that if you have a product-based business model and you are a local champion, you're a services company and you focus on your respective margin, and then the growth that comes into that area are more of sort of generalist projects. If you take on too many of those and you add volume at a low margin, then you get sort of structurally stuck there. It's difficult to bring a company like that from 5% to 15% by just making some changes, because the growth is in that type of margin. And that means that it's usually for services companies in the services and infrastructure segment, most likely in the infrastructure segment, really. The services segment have installation companies representing roughly 75% of the segment, and 25% of that segment is products. Those companies have very, very small project concentration. A normal project is maybe 500,000 kronor and lasts for 4 weeks. So I would say that the risk in those companies are quite limited.
And in terms of the debt levels, you're currently slightly above your target. I think you're at 2.7 currently on a rolling basis, and you have a target of 2.5. But you also state in the Q2 report that you see opportunity, or if you see opportunity to grow, especially in water, you can you feel that you can actually stay above the target level for a while. So does that mean you still have room to make further acquisitions, or should we expect that you kind of work down the debt levels below the target before we see new M&A? Or
yes, I would say that it's today, with the new capital structure that we have in place, we refinanced Vestum in April this year, right? Meaning that we reduced our capital cost by some 30 million on an ongoing basis, and we've gone from heavy bond financing to now heavy bank financing, which essentially means lower interest rates and more free cash flow for fun stuff. That basically means that it's easier for us now to live with 2.8, 2.9 times than it was last year, when the capital structure looked differently. So where does the bottleneck lie here? I would say that if we're above 3 times, you shouldn't assume us continuing to make a bunch of acquisitions. But I do think that it always boils down to a capital allocation decision. Where do we have, where can we achieve the highest returns at a limited or at a low risk? If that is, bringing down leverage, then we'll do that. If it's adding in an acquisition, it's that.
And you have a decentralized model. You work a lot with M&A. So I mean, how do you ensure the leaders in the different units are incentivized and focused? I know that different serial acquirers does that in different ways, but what do you think is the formula for ensuring like value creation in a decentralized model? And how do you work?
Yeah, so the organization in Vestum is structured with 3 functions. We have finance, 6, 7 people doing financial control, business control, etc. And then we have group functions with sustainability, digitalization, and admin. And then we have operations. And in operations, we have 4 divisions. So 4 division managers, all super senior guys coming from being MDs themselves for 5, 10, 15 years, working for listed companies. And they act as chairman of the board in basically 10 companies each. Their main task really is to ensure that we have the right MD in the right company, and that MD is highly incentivized and motivated. Those are basically the main things. And if you look at a company like Vestum, we can be unsuccessful with everything. But if we're successful in ensuring that we have the right MD and that person is motivated, then we will be highly successful, I think. And 65% today of our EBITDA is made up by external MDs. They could have been hired internally, but it's no longer the selling entrepreneur. And that's a very important KPI, because those people are easier to incentivize, right? And the entrepreneurs that we still have in the company, they're phenomenal. They have a vast network and they're great. But it's easier to incentivize an external MD, really. And we work with bonus models that are cash flow based. Everything is based on cash flow. I think that's a crucial aspect, working with working capital and margin on top of just having a profit metric.
And one last question here from my side. Your other target is 15% EBITDA CAGR over time. So please just walk us through, how we look at that target, and if we should view it as you see in the long term that you have a return on capital of around 15%, and you expect to reinvest all that, or how do you view that target, and how do you end up in at that number?
Yeah, sure. So let's break it down organically versus M&A, right? So if you look at our EBITDA today, let's say it's 550 million. And over time, organic growth is somewhere along the lines of 7%. 7% of 550, that's basically 40 million, right? Basically 40 million. And then you have 8% left, which takes you to 40 to 50 million, which have to come from acquisitions. And if you look at our free cash flow on an LTM basis, free cash flow is cash flow after everything, after interest paid, after taxes paid, after leasing amortization, after everything. That number is 440 million invested on an LTM basis. But that includes working capital. And we've released, I think, 111 million of working capital in the last 12 months. If you were to extract that and say that it's not fair to assume that we will always release a bunch of working capital, free cash flow is 330 million. And if we can acquire at 6 times, which is basically our historical average, that brings you to 55 million of acquired EBITDA. So if you add that to the 7% organic growth, you'll get 15%.
Yeah, it makes sense. Thank you so much, Simon, for coming here. And
All right.
thank you in the audience.
Thanks.